What's up guys and welcome back to Wall Street Millennial. If you've been paying any attention to the markets recently, you know that GameStop's short squeeze and insane price action have been one of the most bewildering investment stories in recent history. Since January 13th, GameStop has experienced 3 short squeezes which have more than 6x the stock's value, and on January 25th, it reached an intraday high of more than $140 before the exchanges halted trading. This gives the company a $10 billion market cap, more than double its previous all-time high. What compounds the short squeeze is that Wall Street Bets users not only buy GameStop stock, they also buy an insane volume of out-of-the-money calls. As the stock price increases, the market makers who sold them the calls are forced to buy GameStop stock to hedge their position of selling naked calls. This buying puts immense upward pressure on the stock and can be much more impactful than a traditional short squeeze because of the inherent leverage associated with options. GameStop has historically been a troubled mall-based retailer that has lost share to e-commerce and digital gaming over the years. But recently, Chewy co-founder Ryan Cohen bought a stake in the company and promises to turn it around. This was the initial catalyst that sent shares higher starting in November of 2020. At the same time, Bed Bath & Beyond also saw a significant short squeeze as it has some key similarities to GameStop. It is also a struggling retailer with a new CEO trying to turn around the business. Movie theater chain AMC is also squeezing. It seems like right now, all stocks that were negatively impacted by the pandemic are skyrocketing as retail investors see a bright future. Their high levels of short interest also make them vulnerable to a squeeze. GameStop spiked in the pre-market on Monday, January 25th to more than $100 a share and maintained a level of $98 a share right after the market opened. As of 10 o'clock, the stock was holding strong at around $90 a share. As of 10:45, the stock had spiked further to above $145 a share. This is all despite Telsey Advisory Group, a research firm specializing in the consumer sector, giving GameStop a double downgrade from outperform to underperform. They said that GameStop would go back to around $30 a share as valuations return to a more normal and fair state. Last Friday, Citron Research, the famous short seller who's been ridiculed the entire GameStop saga for being vocally short the whole time, finally rage quit. In a letter dated January 22nd, Andrew Leff said that he would no longer be commenting on GameStop stock. But the short squeeze, or as some people think, the gamma squeeze, is showing no signs of weakness. The first spike was January 13th and 14th, which saw GameStop rise 100% in 2 days. However, the total dollar amount was only $20 a share. Last Friday's run, although smaller on a percentage basis, was a $22 per share increase. In the first hour of trading on January 25th, GameStop has already soared another 120% for an $80 per share increase. For anyone short the stock, this is the biggest gut wrench. This latest move is clearly caused by retail investors, most likely Wall Street Bets users. Since the start of trading, most trades have been in small increments of less than 10 shares. While Wall Street Bets users usually prefer options, some people no longer have enough capital to buy the inflated option prices of GameStop now, especially since due to the fact that GameStop has increased in price so much, there do not exist any out-of-the-money calls, or even at-the-money calls. The highest available strike at the time of this video was $115, which is more than $30 in the money, and costs about $4,500 per contract. All of these calls have experienced high trading volume in the first hour of trading. While the GameStop short squeeze has led to life-changing gains for many on the Wall Street Bets forum, most YOLOers have no interest in selling. For example, user Dumbledore Roth IRA has already made a 600% or almost $300,000 gain on his GameStop calls, but he has no intention on selling until the stock reaches $1,000. This diamond hand sentiment has led to a snowball effect where more and more Wall Street Bets users hop onto the long GameStop trade, but nobody is leaving. So there is a huge trading imbalance in favor of the bulls, which pushes the stock higher. While the move in GameStop stock is partly driven by the turnaround plan of activist investor Ryan Cohen, it is undeniable that the pumping of Wall Street Bets users played a key role, with CNBC's Jim Cramer saying that Wall Street Bets is in charge of the price movements of both GameStop and Bed Bath & Beyond. He also says he doesn't understand why there is so much short interest in B&G Funds, a heavily shorted food company that is also squeezing today. While the short squeeze has been a huge windfall for Wall Street Bets, it has been equally painful for the hedge funds short the stock, including Citron's Andrew Leff. We don't know exactly how much he lost on the position, but it's safe to say this has not been a great week for our friends over at Citron. Obviously, the stock price action of GameStop is unprecedented, and it could easily give up its gains if Wall Street Bets users run out of ammunition to buy or decide to take some profits. Given how unprecedented this short squeeze is, investors should be wary of putting too much money into these Wall Street Bets momentum trades. Contrary to popular belief on the Wall Street Bets forum, these stocks can go down just as fast as they go up. Alright guys, that wraps it up for this video. If you have any thoughts on GameStop or any other Wall Street Bets meme stocks, let us know in the comments section below. As always, thank you guys so much for watching. Wall Street Millennial, signing out.